money makers, Vicki Brackens. Vicki Brackens is the president of Brackens Financial Solutions Network, LLC, and the registered representative of Lincoln Financial Advisors Corp., member SIPC. Vicki, that was my, so we've been talking about community-based violence and young people and what's been happening over the past few weeks. You have some thoughts about that?
Well, I actually attended a meeting on Friday, and the mayor was there, and he made comments around this. And I've seen his comments there in the newspaper, and he has focused on an area that I think should have more emphasis, and that is the economic challenges for many people in the community. Mm-hmm. We see the things that are in the newspaper as far as the poverty rates, et cetera, but really, what are going to be our strategies to correct this? Mm-hmm. So what I'm looking for most, and not to negate or discount anything else that's happening on an emotional basis, but as far as family stresses and the life challenges, but what strategies as a community, as a administrative arm, as far as the city, the county are concerned, what strategies are we going to employ over the next 3, 5, 15 years? Because this is not a problem that can be unwound in a meeting.
Right.
To really address the economic challenges that are happening, because I also heard Hassan Stevens really talk about some of the things that we don't see on the surface that are happening in the background, with young people not having stable homes, bouncing across across the city from one place to another, what do they call couch surfing, things of that nature.
Yeah.
We have to stop right now and really dig very deeply, very strategically, and into what the economic challenges are, and come up with strategies to start addressing those as quickly as we possibly can.
Yeah, and it's interesting that you say that that there's some things going on in the background, and part of, I mean, it's kind of frustrating in many ways, because this isn't a new situation. It's just we feel it deeply. What is it about this moment right now, though? Right? Because, and I think for me, what's hitting me, Vicki, is that it's the number of teenagers.
Correct. Okay.
That's what's hitting me.
When you have a person who's barely spent a minute on this earth, as far as their long-term life expectancy, who's reached such a level of desperation so early in life, it means that we have failed. Mm-hmm. So there's something that we haven't addressed or done that's necessary at this point in time for all of us, from top to bottom, no matter where you live, no matter what part of the county, city that you're in. This issue is a systemic issue that we all have to roll up our sleeves and get involved in. And you're right. The fact that it's young people, I mean, it used to be teenagers, older, younger adults. Okay. How about 10, 12, 15-year-old kids?
7.
Okay?
Right? I mean,
7.
Right. You know, and so when you talk about protection, right, you know, someone was saying Maslow's hierarchy of needs.
Yes.
Right? And if your number one basic level, security. And that's what's being upended. And so we're expecting young people to then go to school
and learn
in that context.
Okay. And that's an impossibility. Okay. So I say this quite often. I think I've said it before on the air and with a lot of people, that I am grateful for the opportunities and things that have happened in my life that have put stability in my life, probably the majority of the time, through either the community and the village, as they say, that has surrounded me. But we now are at an inflection point in this community where we have to now stop right where we are and figure out what step we missed and put that back in place. Okay.
I ask you, people might say, well, you know, and we're going to talk about your money in a minute.
We're going to talk about money.
In a minute.
But this is actually, let me stop right here.
Right.
This is actually about money. And so if you recall, several weeks ago when we came up with our formula for net worth,
yes,
it was human capital
right,
plus financial assets equals a holistic, equals total net worth. When we are losing our human capital to violence or depression or a feeling that they have no worth and no one cares about, when we are losing that human capital, the collective net worth for the city of Syracuse, for Onondaga County, is now decreasing each year, not increasing. This is a total problem. This is a problem across the board that we all have to address, because if we want this community on an economic basis to continue to thrive, or at least to get back on its feet, when we have 50% of the human capital in a point of economic stress, no matter what we do on top, we will not be able to move forward at the rate that we want to move.
I would say one more thing, Vicki, because I'm thinking about it in terms of whose lives matter. And there's some thought about how this particular young man, the young man, the 12-year-old that got killed, how his story was covered versus how other stories are covered. There's some thought about, what we value and, the coverage and, funeral services being posted. But when some of these other young people pass, we don't really hear. It just sort of happened and it goes away without recognizing that we've got to be very careful about giving equal concern about all of our young people.
That's correct. All across the board, because as I was saying, this is a total problem. We must value everyone's humanness. Is that a correct word? Humanity.
Yeah.
Okay. Across the board. Okay.
And how stunning was it for me to read that list of all of the people?
Oh, I heard you read, and I'm sitting here with you and about to cry. Okay, and I'm going to tell you why. Okay, not only is it devastating, but when you put the list together, because and this is a totally different subject, but our lives are in such hyperdrive most of the time, that we don't step back and actually compile and look at the total impact. It's incident after incident that has not necessarily been connected, so we can really understand that between September and today.
Right, 1 month.
That's a month. That was a month, okay? And you read 13 or 14 different incidents. Yeah. That means every other day.
Right. And this is just of people between, 7 and 19. Right? So that doesn't include people older than that.
Right. Okay.
So, all right. Hey, Vicki, let's talk about your money.
Okay, George. And we're gonna. I love when I talk to you early about what I'm going to talk about, because you always steal my topic.
I know, didn't I? Well, no, I didn't steal it. I just told people what we're going to do.
Right. Okay. But anyway, today is about deja vu all over again. For many of you who are seasoned listeners out there, I'm sure you recognize that quote. It's deja vu all over again as being one of the top 25 quotes from Yogi Berra. For those younger people out there in the audience, it is Yogi Berra, Berra, not Yogi Bear, Yogi Berra.
Yeah.
So I want you to go to bleacherreport.com and read about Yogi Berra and his 25 quotes. I'm starting this way, George, because almost exactly 8 months ago, my topic on this show was the recent market volatility. What should we think?
Okay.
As a refresher, I encourage everybody to go back and listen to episode 27, which you can find on my website at brackensfsn.com, and go under the radio tab. Well, at that point, we were experiencing for the first time a taste of increased market volatility. In fact, we hadn't had any market volatility for almost 18 months. And back then, which feels like a century ago, the factors that were being talked about that were contributing to the sell-off were basically this: a stronger than expected January jobs report, which showed rising wage pressures, which had increased concerns about inflation and possible change to monetary policy. We also had market interest rates starting to climb in response to this wage growth. And this triggered further selling as far as trading was concerned. We also had deficit spending measures looming as the federal budget negotiations were continuing. And several leading technology and energy companies were starting to report disappointing profits despite an otherwise strong earnings season. And finally, volatility has always historically increased in midterm election years. And we also had a new Fed chairman, and the market has a propensity to test the new Fed chairman's resolve as far as monetary policy. Well, this message in the week of February 5th was so much like the message of today. In fact, George, I started to tell you, I'm just going to phone it in.
Right.
Push button number 27,
right.
and let's go on from right there. But like that week, I will say right now, so everybody listen to me carefully, we are not going to, with the remaining portion of our discussion today, give anybody any specific investment advice. We want you to go to your own professional to look at your specific situations as far as your investment advice is concerned. So here's some big facts that we have that we're looking at right now through this last 1,300-point slide or so that we had this week. The lowest unemployment in 49 years we are experiencing right now. With that, there's an anticipation of higher cost of wages, which is going to cause employers, or is causing employers, to worry about rising yields on the Treasury notes.
Okay.
Ring the bell, because I don't know if everybody knows Treasury notes.
Here we go.
All right.
This is our jargon bell.
Right. I want you to go to, I'm going to give everyone an assignment. Go to Investopedia.com.
Right.
Look up Treasury notes. But in a quick aside, a Treasury note is a type of bond that's issued by the federal government.
Okay.
And they are key to economic activity. So right now we have rising yields or rising interest rates around Treasury notes. So George, may I ask you a question here?
Yes.
If you had a choice, which I know you do, and you were really truthful, which I know you always are.
Yes.
In your heart of hearts, if you could get a guaranteed, steady Eddie, no fluctuation return of 3, 4, 5, or even 6%, would you actually choose to invest in something that had no guarantees of return and every minute fluctuates in value? What would you choose to do that?
The safer bet.
Would you take the safer bet?
Yes.
Well, that's the dilemma we're facing right now.
Right.
The economy's strong, wages are going up, yields are going up, which means the steady Eddie guaranteed instruments are going up, and now investors are having to choose. Would I feel more comfortable with something that is steady and guaranteed versus something that's always fluctuating in the future? So that's the dilemma that we're facing. So I don't know if these circumstances, as far as increased Treasury yields, will continue, or increased employment will continue. But I can look back at trends and history, and look at events in the past, and extrapolate to circumstances that are similar today, and possibly predict that if these trends follow the same pattern, then the outcomes may be the same, or we may have the same results. And that's exactly what happens in the market. So here are some of the trends that we're looking at right now.
All right.
Fact number one, higher yields tend to create attraction away from risky assets. Number two, stronger employment and lower unemployment creates higher demand for workers, and thus employers need to increase wages to attract employees. Well, as wages get higher, they require more money to be spent by the employer to support their number one expense, which we have in business, which is people.
Yeah.
To get more money, number four, to get more money, employers need to raise cost of goods and services and cut expectations for profits.
Okay.
So by cutting expectations for profits, I always tell you, these all things are all linked together. So when you cut expectations for profits, the forward-looking outlook for profitability decreases, and this decrease in forward-looking future profitability creates an uncertainty for the business, and as such makes a business less attractive to investors. And because I love Shark Tank, and I love Kevin O'Leary.
Kevin O'Leary
always says on Shark Tank.
What's he call it? Mr. Wonderful?
Mr. Wonderful. Okay.
Yes.
How do I get my money back? So investors are always asking this because they want their money back and they want a profit. So if the company transfer of ownership instrument, which is what a stock is, in that case, they have to reprice, or in this case, reprice it down in order to attract more investors if the profitability for the future is in question. And this repricing, whether up and down, is going on constantly based on, and this is really, really important.
Go ahead.
Based on the perceived future value of companies, their operations, and their development. Man, that was a mouthful.
Yes, it was. I
hope
should ring the bell again.
Okay. So connecting those dots between current and future profitability is really what's happening when you see the fluctuations in the marketplace. So let's look at this in a different way, because I think when we connect the dots, it's also important that we make sure that everybody understands the language that we're using.
Mm-hmm.
Market versus the market or the stock market.
Right.
Okay? Because we're accustomed to going to a market, which is really a gathering place where things are offered for exchange, more commonly where sellers are gathered together in a central location, offering their goods and services for something that you buy right now for a stated price. You are paying for something right now that has right now value.
Go ahead.
But the stock market, on the other hand, you are buying something now that is being sold based on an anticipated value. That these things in history have shown that anticipated future value will be impacted by certain economic processes. And one of the biggest ones is confidence. Confidence in the stability of the future instrument plays a large role in whether markets go up or down. Investors are more likely to purchase a stock if they are convinced their shares will increase in value in the future. If, however, there is reason to believe that shares will perform poorly in the future, there are often more investors looking to sell than to buy. And here are the events that the investor confidence will be impacted by. Love this list.
Yeah.
Wars or other conflicts.
Okay.
Concerns over inflation or deflation.
True.
Government fiscal or monetary policy. That's basically what the government has said they're going to do with money. Technological changes.
Go ahead.
Natural disasters and extreme weather fluctuations, and corporate or government performance based on the data. For example, the largest single-day decrease in the history of the Dow took place on September 17th, 2001. That market loss traded down almost 7% in value that one day. This move was attributed to September 11th and the terrorist attacks on the United States because it created a massive level of uncertainty and a massive decrease in confidence. So to start, I ask everyone, as far as how you view the market, meaning the stock market, I want you to start listening closely to certain information around the current activity that really drives future results. Employment numbers. Consumer confidence. There's actually a report that comes out that measures consumer confidence. Purchase order activity. Transportation activity, to name a few. And I want you to also start learning about the fourth industrial revolution. In fact, George, we're going to put a link to that on my website and yours.
Yes.
Okay? Because the real economy is the future driver of the activity of the market. How you connect to and participate in this fourth industrial revolution is key to your ability to increase your net worth every year. So for everyone to dig deeper into this topic, please go to one of our favorite resources, which is Investopedia.com, or to the Inspiration for the Nation Facebook page, or to my website at BrackensFSN.com. And at this point, George, unless we have something else, okay, as far as any questions, I'll say our plate is full.
Well, that was a lot.
That was a lot.
That was a lot.
Okay.
There was a lot of information there.
Okay, I hope everyone will take a moment, and I know you repost this.
Yes.
So you may need to listen to this one or two times.
You really do. We're going to have this for you later on today. We'll have it on our Inspiration for the Nation Facebook page. And we'll also have the links for the Industrial Revolution. And what it will also do is find the other episodes so that people can make the connection.
Exactly.
So we'll do all of that for you today. But right now, we just got to say bye-bye for now. Vicki Brackens. Vicki Brackens. Yeah. Let's see. She's the president of Brackens Financial Solutions Financial Advisors Corp, member SIPC.